Hello, this is Dr. M. N. Prakash. Welcome to my video. So we were out for 2 weeks, so we are back now. So lots of things have happened. So let's start with sharing the charts right now. And here come the charts. Okay, share. All right, now you can see my charts. So as usual, I'll start with my disclaimer, which essentially states that the investment decisions are your own. And what I give here is informational data, and you make your final decision. Okay. All right. Having done that, let's look at the market. So let's look at the market year to date. So the market started around 38, 37, I think. And then there was a lot of euphoria about the interest rates passing, Fed passing the rate increases. There was euphoria about the income statements or the earnings of companies improving, and also the January effect, wherein a lot of money comes into the market to buy stocks. So the market did very well in the first few weeks. It crossed 3150, and then bad news started coming. The inflation data was not good. The Fed officials were giving hawkish statements. And then last week, Powell went into the Congress, and both in the House and the Senate, he gave a very hawkish statement, and he kept saying that they're going to increase the interest rates beyond what they thought before, and it's going to be higher for longer. And then the SVB happened, the Silicon Valley Bank. They collapsed. They had made lots of mistakes. They had invested all their money in bonds, and then the treasury bonds, which are very safe from the perspective of the principal. But as the interest rates started going up, the market value of those assets started coming down. And at the same time, they had a single segment customer base, which was venture capital companies or startups. And they started taking out money, and they couldn't meet their cash flow. And eventually things went out of control, and they collapsed, and FDIC took over. So the market essentially made a round trip. So right now the market is 3861, which is very close to where it started the year. And we haven't really gained anything. YTD, the market is up 0.58%. So what happens from now? So that's the question. So let's look at just the last week performance. You can see last week was pretty bad. It started near 4,000, 3981, and now it's around 3861. So it collapsed more than 100 points, or minus 4.5%. Okay, it's down more than 4.5%, right? And the bonds, were actually doing better, because the people started thinking that with the interest rate going up and the economy going bad and the banks going out of business, the Fed will be more careful. So the bonds actually did fairly well, but the bank stocks took a lot of beating. Okay, so I think for the next few months, the stage is set up. What you will see is there is a lot of bad economic data coming out. The inflation will not improve a lot. In fact, it may even get worse in some areas. And the Fed will be in a tight position. They how much they go up in terms of interest rates, and at the same time, how do they make sure that the economy won't collapse, the banking system won't collapse. So my forecast, the modeling I've done tells me that the stocks will be under pressure, a tremendous pressure for the next few months. Okay. So let's look at the opportunities. So the question is, when and where are the investment opportunities, right? So as I said, the stock market is going to have a rough time over the next 3 to 6 months. And the S&P 500 will reach around 3,200. That's the model forecast in Q2, Q3 period. So when it hits that area around 3,200, that's where you have a lot of opportunities. So what does 3,200 mean? From today's market value, it's going to be a 20% drop in the overall market. So there's a steep drop. So should you go and buy today? No, but you should be making a shopping list, right? What are the quality dividend growth stocks which have good cash flow and also in different sectors so that your list is diversified. And then when the market hits the bottom, around 3,200, you should buy these stocks, okay? And also, in addition to these stocks, there'll be a lot of income opportunities, income generating opportunities. Okay, what I mean by that? There are opportunities in bonds, some high yield bonds, and there are opportunities in equity funds, which also give you a lot of dividend. And there are also opportunities in master limited partnerships. These are things you could buy, which will generate you consistent income on a monthly basis. Okay. So let's spend the rest of this presentation on those opportunities instead of going through individual stocks. Okay. So I selected 4 opportunities for you, and for the next 3-4 months. You don't buy them today, and I'll tell you when is the opportunity or when is the buy zone for buying these opportunities. So the first one I've selected is PTY, which is a closed-end fund. It's a bond fund. It's a high-yield bond fund. So what it means is, it's managed by PIMCO. So what they do is they have a fund which is around $1 billion or so in that fund, and they lend that money or they use that money to buy bonds, high yield bonds all over the world, in the US, in Europe, in some of the emerging markets like Brazil, and also in several sectors of the economy, sometimes in construction industry, sometimes in industrial industry, sometimes in transportation and things like that. So they're diversified sector-wise, and they're also diversified geography-wise. That's how they try to manage the risk. The other thing they do is they leverage. In other words, they use that $1 billion they have, and they use that to lend around 1.5 billion. How can they do that? They can use that money they have to get funds at a lower interest rate in the US, and then and buy those to buy bonds which pay a lot more interest in outside the US, in some of these medium-sized companies. So because of that, they can give a higher payout. So their yield, the dividend yield, their monthly dividend yield is around 11%, which is very high. And obviously, it's very high because the companies that they're investing in, the bonds they're buying, are mid-sized companies, so their ratings are not solid, right? But they're investing in many, many companies, so the risk is managed. And it has been there for a long time, and they're done fairly reasonably in this period. Just like stocks, this fund goes up and down. So you have to be careful when you buy it. You never buy these funds or stocks when they're at the top, right? So over the last 52 weeks, this fund has been between 11.38 and 15.91. The range is not that bad compared to many stocks. And over a 5-year period, because we want to look at the 5-year, because we have had some real problems in the last 5 years. The pandemic happened in the March of 2000. The market took a beating. Even then, they held up fairly well. The bottom they reached during that time is 9.1. And the top was around 21. So this is a decent fund, a good fund to invest in high yield market. Okay. The second one I have is the JP or JEPI, which is the JP Morgan Equity Income Fund. So what do they do here? They take the money. It's an open fund, so people pour the money into this fund. They take that money and invest in S&P 500. So they're just like the stock market. However, they do generate extra income for the investors using covered options, covered costs basically. So because of that, they're able to pay a lot more dividend. They're paying, today, for example, 12%, which is pretty high. Now, just because they try to S&P 500, the value of this stock or this fund goes up and down just like the S&P 500. So over the last 52 weeks, their low was around 49.82, around 50, and their high was around 62. On a 5-year period, they were around 50 low and around 64 high. So, you're taking almost the same risk, identical risk as the overall S&P 500, but you are going to get a lot more income from this. Okay, so we will talk about that also. Now, the third one is the BST, or the BlackRock Science and Technology Fund. So what do? They invest that money in companies, emerging companies, medium companies, and large companies, which are in science and technology area. So something like, NASDAQ companies, which are in technology, but they're global. They invest in technology companies in Europe. They can also invest in technology companies in Asia. And they pay a good dividend. And the way they pay dividend again is through covered options. Okay. And they're paying around 9.5. However, they've done in the last 12 months or 52 weeks between 27 and change and 44 and change. Very similar to the NASDAQ high and low. And then over the 5-year, they have been around 22 on change and 62 on change. So it's very much like investing in the, let's say, NASDAQ market, QQQ, for example, but with a very high dividend of around 9.5%. Then the fourth one I have for you is the Energy Transfer Company, ET, and it's a Master Limited Partnership, MLP, they call it. And they closed around 12.7 on Friday, and their yield is around 9.46. And the range has been 9.15 to 13.67. And over a 5-year period, their range has been pretty big, 3.75 to 19 and change. So what does this partnership do? As the name tells you, they are in energy investments. They invest their money in building an energy infrastructure. So they have a network of pipes that go from Texas and Louisiana, Oklahoma, and places like that, all the way to Pennsylvania, and then all the way to Northeast. So they get the oil and gas produced in the Texas, for example, in the Texas markets, and they transfer it to say northeastern market. And for the natural gas, they even compress it. And then they even have the capability to store it. And at the terminal, for example, in the Northeast ports, they can, compress it, liquefy it, and then they can load it into ships which they carry this liquefied natural gas to European markets. And as you know, because of the war going on in Ukraine, Europe is having a lot of energy crunch because Russia is not supplying them enough. So there's a big opportunity for US natural gas, liquefied natural gas, and this company is benefiting. The low of 3.75 in the 5-year period happened around the pandemic time frame when people thought the economy was going to collapse and there would be any demand for oil and gas. And that's when their thing went down a lot. Now, in all of these cases, the dividend you get is not a qualified dividend. What does it mean? You don't get the preferential tax, treatment for the dividend like you get for regular dividend, wherein in the maximum, income tax rate is around 22%. So these are good things to own in your IRA. Okay, of course, you don't want to put a lot of money in this, chasing these high dividends. You need to have a little bit of money in high dividend opportunities, and these 4 fit into that. So let's say you want to have 10% of your portfolio in high dividend opportunities, okay, or 5%, depending on your risk tolerance. Then if you distribute between these 4, I think you're fairly well diversified. And now, over the next 3-4 months is a great opportunity to pick up these funds, okay? So let's spend a few minutes on each of these. And then, we'll see how they did in the last year and when is the buying opportunity. So the first one is the PTY. And you can see it has gone up and down just like the market. For this fund, there are 2 risks. You should always talk about risk. One risk is the high interest rate, because when the interest rate goes high, because there's a high yield bond, they will have to give more interest, which means their value has to go down. and they had to keep the spread between high quality bonds and high yield bonds, somewhat constant. So when the interest rate goes up, the yield that generated from these bonds had to go up, which means the value of the fund has to come down a lot. So that's the reason you have this range of 11.38 to 15.91. And every time, the interest rate went up, the fund has been affected. The second thing that affects this is the economy, because if the economy is going south, the companies that have issued bonds and this fund owns may have some problem, with their bonds. So that's always the market fear, and because of that, again, the fund value goes up. It goes down. But when the economy improves, the fund value goes up. Okay, so right now you can see the fund value is going down. So on Friday, it hit around 12.66, not too far from the low for the 52-week, which is 11.38. So when is the buying zone? When the fund value starts, going below 12, when this market price for this fund starts going below 12, that's when you can start, picking this fund. And of course, you never buy everything at once. You buy in chunks. Okay, so it will probably, uh, languish between 11 and 12 over the next 3 to 4 months, even between 10.5 and 12, over the next 3 to 4 months. Then you can dollar average and build your value in this portfolio. Okay. So the next one is JP, which is the JP Morgan Equity Premium Income Fund. It's an ETF, and you can see the value of this fund has basically tracked the S&P 500. So you buy this stock when the S&P 500 is near its low, right? So the forecast is for S&P 500 to be in the region of 3,200 over the next 3 to 4 months. That's when you go and buy this fund. So when this fund starts going below 48, that's an excellent opportunity for you to build this fund. And this fund, is fairly broad-based equity market fund. So it's a fairly, safe fund over the long period, because over the long period, the S&P 500 will do okay, will actually do pretty good. So if your holding time is long and you want some income coming during that holding time, this is an excellent fund to own. Okay. The third one is, of course, the BlackRock Science and Technology Fund. Okay, this is a closed-end fund. The range has been 27 to 45, and you can see, and if you really correlate this with the NASDAQ market, it will be having a very similar picture, right? This is also sensitive to interest rates, because tech stocks are highly sensitive to interest rates, and it's also sensitive to global economy because they invest in stocks all over the world. And what is the entry point for this? When it starts going below 30, I would start, picking small amounts of this fund when it starts going below 30, and maybe it will hit around 27 again. And between 30 and 27, try to build your portfolio in this fund. Okay. And then once you have that, you will enjoy a good dividend coming out. The fourth one is the MLP we talked about, the Energy Transfer, which is actually based in Dallas, Texas. And they, have gone up and down again with the oil prices. They're very sensitive to the oil prices, and they're very sensitive to the economy. If the economy goes south, then the demand for energy comes down. So they won't have a lot of, oil and gas to transfer. However, they are already in a fixed contract with lots of these suppliers, these oil companies. So they will actually do a little bit better than how the oil companies themselves will do. And they pay pretty good dividend. Okay. So when this stock or the fund goes below 11, that's an excellent, entry point for you. Okay. So in summary, there are 4 income opportunities for you. One is a high yield fund, which is PTY. Another one is an equity fund, a broad-based equity fund, which is JP. Third one is the, a focused fund, BST, which is a technology fund, and the fourth one is ET. So you can try to distribute your portfolio for income portfolio between these four funds. Okay, so that should finish our presentation. So we'll take a spring break and we'll be back in April. And by that time, I'm sure there'll be lots of opportunities in the market, and we'll talk about that. Okay, thank you very much, and we will start this presentation. Okay, thanks.